Dear friends, and welcome back to the channel. Before we dive in, I want you to imagine something for a moment. You have some money sitting in your bank account right now, not doing much, slowly losing value to inflation, and you are looking at two options sitting right in front of you: gold at $5,100 per ounce and silver at $83 per ounce. Both are precious metals. Both have been around for thousands of years. Both are surging in 2026. But only one of them might be the right choice for where you are financially right now. So today, we are going to break down everything: the prices, the data, the driving forces behind each metal, what the biggest banks on Wall Street are saying, and most importantly, which direction each of these metals is likely to move in the weeks and months ahead. Stay with me, because by the end of this video, you are going to have a much clearer picture of exactly what is happening in the precious metals market right now, and what you should be thinking about. Let us start with gold, because gold is the metal that is making the biggest headlines in 2026, and the numbers are honestly extraordinary. Right now, gold is trading at approximately $5,105 per ounce. That's up about 0.5% on the day. But here's the number that really puts things in perspective. Just 12 months ago, gold was sitting at around $2,624 per ounce. That means gold has gained more than 100% in just 1 year. Think about that. If you would put $10,000 into gold 12 months ago, you would be sitting on over $20,000 today. No stock, no crypto, no real estate in that same period came close to matching that kind of return for that level of stability. And it does not stop there. Year to date in 2026, gold is already up 18%. It recently hit an all-time high of $5,589 per ounce before pulling back slightly. And even with that pullback, even with a 3% correction this week that snapped a 4-week winning streak, gold remains one of the strongest performing assets on the entire planet right now. So the question everybody is asking is why? What is actually driving this incredible rally? And is it real, or is it just hype? The answer is that multiple powerful forces are all pushing gold in the same direction at the same time. The first and most significant driver is what economists are calling de-dollarization. Central banks around the world, particularly in Asia, the Middle East, and parts of Europe, are quietly reducing their holdings of U.S. Treasury bonds. They are taking those dollars and recycling them directly into physical gold. This is not a small trend. This is a structural shift in how nations are storing their wealth. And when central banks buy, they buy in enormous quantities that move markets in ways that ordinary investors simply cannot. The World Gold Council confirmed that gold ETFs alone absorbed $5.3 billion in February 2026, which is equivalent to 26 tons of gold, led by North American and Asian buyers. That's institutional money. That's serious demand. The second driver is geopolitical uncertainty. Ongoing conflict in the Middle East is pushing investors towards safe haven assets, and gold has always been the ultimate safe haven. When the world feels unstable, when people do not trust paper currencies or government promises, they run to gold. That has been true for 5,000 years, and it's still true today. The third driver is the Federal Reserve. Right now, there is enormous uncertainty around the direction of U.S. interest rates, but more importantly, the Fed Chair Jerome Powell's term expires in May 2026. Markets are watching very closely to see who replaces him. If a more dovish, more rate-cutting friendly chair is appointed, gold could see another explosive surge. If a hawkish chair comes in, there may be a temporary cooldown. But most analysts believe that regardless of who takes over, the long-term direction for gold remains upward. Now, what are the biggest banks on Wall Street actually saying about where gold goes from here? Goldman Sachs is projecting gold will reach $4,900 per ounce by December 2026. Bank of America and JP Morgan both see a clear path to $5,000 and beyond. JP Morgan's global research team is forecasting gold to average $55 per ounce by the fourth quarter of 2026, rising toward $5,400 by the end of 2027. And the most aggressive forecast comes from Yardeni Research, which is predicting gold could hit $6,000 per ounce before the end of 2026. These are not random internet predictions. These are the most powerful financial institutions in the world, making formal, published price forecasts, and they are all pointing in the same direction. This week specifically, traders and analysts are watching the upcoming release of U.S. CPI inflation data for February, along with U.S. GDP figures for the fourth quarter of 2025 and initial jobless claims. Any surprise in these numbers could create significant volatility in the gold market. A higher than expected inflation reading would likely push gold even higher. A lower inflation reading might cause a short-term pullback, but the broader trend remains firmly bullish.
Now let's talk about silver, because silver tells a completely different story, and in many ways, an even more compelling one. Silver is currently trading at approximately $83 per ounce. That's up significantly from around $30 just over a year ago, meaning silver has also delivered extraordinary gains. But here's what makes silver unique, and why some analysts believe silver may actually be the more exciting opportunity right now. Silver is not just a precious metal, it is also an industrial metal, and that dual nature is creating a perfect storm of demand that most people are not fully aware of. Let us break down exactly what's happening on the industrial side of silver's story. The solar energy industry is consuming silver at a rate that is genuinely staggering. Every single solar panel manufactured requires silver, and as governments around the world accelerate their shift toward renewable energy, solar panel production is growing at an extraordinary pace. Demand from the solar sector alone has increased by more than 150% over the past 4 years and shows no signs of slowing down. Then there is artificial intelligence. AI data centers require enormous amounts of electrical infrastructure. Silver is one of the best electrical conductors on Earth, which means it's critical in the manufacturing of chips, connectors, and circuit boards that power the AI revolution. Every time a new data center is built, every time a new AI chip rolls off the production line, silver is part of that process. And the AI build-out happening right now is the largest infrastructure investment in modern history. This industrial demand surge is happening at exactly the same time that silver supply is struggling to keep up. The silver market is currently in its 5th consecutive year of a structural supply deficit. That means the world is consuming more silver than it is mining every single year, and supply can't simply be turned on like a tap. Most silver in the world is not mined directly. It's mined as a byproduct of copper, lead, and zinc mining, which means even if silver prices rise significantly, mining companies can't simply increase silver output overnight. The supply response is slow and constrained. Physical inventory levels at COMEX in New York and the Shanghai Exchange have both been falling to critically low levels. When vault inventories drop, it creates additional upward pressure on prices because buyers cannot find the physical metal they need. This is not a short-term blip. This is a deep structural issue that is going to take years to resolve. Now, the gold-to-silver ratio is something every serious investor needs to understand. Right now, that ratio sits at approximately 1:62. What that means is that 1 ounce of gold buys 62 ounces of silver. Historically, that ratio has typically ranged between 70-1 and 90-1. The fact that silver has been outperforming gold and closing that gap is significant. But here's the even more striking number. When you look at how much gold and silver are actually produced from the earth, the production ratio is approximately 1:8. For every ounce of gold mined, approximately 8 ounces of silver are mined. Yet the price ratio is 1:62. That means by production standards alone, if silver were priced proportionally to gold at $5,000 per ounce, silver should theoretically be trading at around $625 per ounce. That's not a prediction. That's simply what the math says about the current pricing disparity. So where is silver headed from here? This week, the short-term picture is slightly bearish. Algorithmic models and technical analysts are projecting a potential decline of approximately 7% over the next 7 days, with silver possibly pulling back towards $78 to $79 per ounce before finding support. This kind of pullback is normal after an asset that recently touched triple-digit prices. Profit-taking, position squaring, and short-term macro pressures from the CPI data release are all contributing to near-term caution. But the medium and long-term picture for silver looks significantly more bullish. A 5th consecutive supply deficit combined with exploding industrial demand from solar and AI, alongside the tailwind of gold's continued strength pulling silver upward, creates a fundamental setup that many analysts believe is unlike anything silver has seen in decades. If gold continues toward 5,400 or higher, silver historically amplifies those moves. When gold rallies hard, silver tends to rally even harder in percentage terms, which means for investors looking at the precious metal space, silver could offer more upside leverage if the broader precious metals bull market continues. So which is the better investment right now between gold at $5,100 and silver at $83? Here's the honest answer. They serve different purposes, and the right choice depends entirely on what you are trying to accomplish. Gold is stability. Gold is the ultimate store of value. It's what central banks hold, what institutions buy, and what has preserved wealth for civilizations for thousands of years. If your goal is capital preservation, if you want to protect what you have already built from inflation and geopolitical risk, gold is your answer. The institutional backing, the Wall Street forecasts, and the structural demand from de-dollarization make gold's foundation extremely solid. Silver is opportunity. Silver is for the investor who is willing to accept more volatility in exchange for potentially greater upside. The supply deficit story, the industrial demand explosion, and the severe historical undervaluation relative to gold all point to silver having significant room to move upward over the next 1 to 3 years. Yes, it will be more volatile. Yes, it can pull back sharply in the short term, as we may see this coming week, but the long-term structural case for silver is genuinely compelling. The smartest approach, if your situation allows it, is not to choose between them, but to hold both. Use gold as your foundation and your protection. Use silver as your growth position and your leverage play on the broader precious metals bull market. Because here's the truth. Whether you believe the economy is heading for turbulence or recovery, whether you're worried about inflation or dollar weakness or geopolitical instability, Both gold and silver have historically been among the most reliable ways human beings have protected and grown their wealth. And right now, in 2026, with gold at $5,100, silver at $83, and every major bank on Wall Street pointing higher, the precious metals market is telling us something important. Pay attention. This is not financial advice, and you should always do your own research and consult a qualified financial advisor before making any investment decisions. But the data is the data, and the data right now is speaking very clearly. If you found this breakdown valuable, please give this video a like and share it with someone who needs to understand what is happening in the precious metals market right now. Subscribe so you never miss an update. And drop a comment below telling me which metal you are watching most closely right now, gold or silver. I read every single comment and I would love to know what you think. See you in the next one.